If you're a U.S. person with an Australian superannuation fund, you might have heard you are completely screwed, or you might have heard you have no problem at all. Recently, a U.S. tax professional sponsored an article in the SMSF Advisor, a source for self-managed superannuation funds, claiming that he and only he found the secret to the proper tax treatment of all superannuation funds. Bottom line, we wish what he was saying was true. But as attorney Hanson and I dissect this argument, we find numerous flaws that create unnecessary risks rather than alleviate any problems. The video that follows is a tad long, but if you really want to understand the U.S. tax treatment of superannuation funds, we think it's a great place to start and really worth your time.
Hello, Anthony.
Hello, Claudine.
And hello, we're being joined today by a very special guest, our lead international attorney, Robert V. Hanson. The
Hello.
V stands for victory?
V stands for victory.
Okay. And we want to talk about the treatment of superannuation funds. We came across a pretty interesting article on SMSFadvice.com. Advisor. Thank you. So, Anthony, talk about that.
Yeah, so this was something forwarded to me by a CPA of one of our accountants who has a superannuation fund, and we're sort of it's a bit of work that we have to do on that. And here's this article written where basically saying that we're doing it all wrong, and that it's really simple, that there's a lot of confusion in the U.S. with regard to proper U.S. tax treatment of Australian superannuation. It's exempt from U.S. tax under the treaty, and here's why. And that's the claim made, and I guess I have to take a little bit of offense to that because it's not correct. And this is a promoted article by Castro and Company, international tax attorneys, and I would just put an asterisk there. I might explain a little bit more about that why. And so as we went through this article, we just sort of, we wish some of the things he's saying were true.
Yes.
We absolutely wish a lot of what he was saying was true. We wish that Australian superannuations were exempt, that they were simple, that you basically would just have to report it on FBAR, not have to pay taxes on it, not have to do the onerous reporting sometimes required if something is called a Grantor Trust. Okay.
So the article makes it sound easy to do, but from our experience, we know that's not.
Well, the article makes it sound easy to do, but you just need some special sauce that the Castro and Company will provide for you if you are their client, and then you're going to be automatically protected from your superannuation. So he does go, and I mean, it would be nice, I guess, if, the little guy was right. If the little guy standing up against the entire U.S. tax industry had a great point, and just everybody was doing it incorrectly. Yeah. But I think we run into some problems right away. And I would say one of the first problems I have with it is that he makes the claim that he says the vast majority of U.S. practitioners in the U.S. treat Australian superannuation as taxable foreign grantor trusts on the basis that it's a private pension that does not constitute a qualified retirement fund under Code Section 401 of the U.S. Australian Income Tax Treaty. Okay, that's not true at all. That is absolutely not true. Many times we will treat them as an employee trust.
Right.
And the employee trust, Robert, what do we do with that?
Well, if you're an employee trust, to get that, basically, you have to be at least equal contributions between you and your employer for the superannuation fund. And by Australian law, that's the case, as long as you are, I'll call it a regular super fund. He mentions self-managed funds later in the article. But if you are this employee's trust, you don't have a 3520 requirement, the growth in your fund is not taxable, your contributions into that account by your employer are still taxable. But at least the growth in it, the thing that you are thinking that, that's in my retirement account, that's not my income. That thing, that's already tax deferred until you take a distribution. You still got to report it on your FBAR, you still got to report it on your 8938, no 3520 requirement. But it's not true that they're all grantor trusts. Grantor trust is when, that's more like a IRA in the U.S. context, where it's me just putting money into this account, and there is some fiduciary duty by the company, by the bank, to grow my funds so that I can retire at 65 and lay on the beach. That is just all me. There's no employer, there's no third party, there's nothing like that. That's the grantor trust, and that's when the growth in the fund flows through from that foreign IRA onto my personal tax return.
Yeah, and that's what everything comes down to. When we're talking about Australian superannuations, we're always looking to see, can we treat it like an employee trust? We want to, because it is not that complicated. It really isn't. Just make sure we get the value on it, 8938, put it on the FBAR, and really, we're done. We do the rest of the return too, but a lot of times a foreign income exclusion for a tax credit, you're really not talking about a huge nightmare, a big deal. It's really not that. If you do have a few years you haven't reported, you'd want the streamline program, but you don't have any penalty to pay on that. So it's not that bad. And that's where he's treating every superannuation the same, as if everything is a grantor, and it's not. There's employee trust, because his proposal for things that are employees trust are the same proposal for grantor trust, which is where he takes this, you have to file a form 8833 and take a treaty position. Well, to me, that just seems like overkill. Why would you do that? You don't need to do that. That's not required. All you're doing is saying, hey, give me extra attention. That's what you're doing. So I think that's sort of a waste of time and a little bit inappropriate. There's no treaty position you're taking, correct?
For probably the majority of people with a regular super fund, you don't need to go to a treaty position at all. You can stay within the Internal Revenue Code and just say, hey, Section 402B, I qualify as an employee's trust. I don't have any income reporting from my super fund at all.
Now, things do get more complicated, though, when we deal with situations where people do put more money into a super than their employer. And also, this was on the SMSF advisor, self-managed superannuations, and we run into problems there because, and sometimes there's the rule on whether or not something is a grantor trust or an employee trust is based on contributions, which is kind of crazy. It's really not a good rule, because a grantor trust is that basically you? Is a grantor, is that just one of your alter egos and you're saying it's not? That is what it's designed to do. But your contributions really don't define your control. So the thing is if you do have a self-managed superannuation funds and your contributions were 50-50, the rule actually helps you. Because even though you have control over it, you're allowed to treat that as an employee trust, correct?
For certain self-managed, maybe if it's a qualified rollover. If it's not a qualified rollover, then you're stuck with the grantor trust.
Okay.
That's what it is. So if you roll it over and you self-manage it and it doesn't qualify, then you're stuck with your grantor trust rules, because now you've created this new thing that is its own trust at this point. And that's when you get in trouble, which is something that the article kind of alludes to towards the end, referencing something to if you have a self-managed, but there are certain preserved portions from what the original trust was to the new trust. So it depends. It's very fact specific. You have to look at, okay, what did you do? Who has access to the accounts? Who has access to the funds? What can you do with the funds? Who put the money in? How much was it your money? How much was the employer's money? There's several things that go into this that will determine the ultimate tax treatment for your super fund. Like we said before, if it's a regular fund, it's 50-50, you don't even need to get to the treaty position. You can just stick within the Internal Revenue Code.
So if someone comes to us with issues about a superannuation fund, it's not just, oh, this is what you do, end of story. It's literally case-by-case basis.
It can be.
Yeah, it can be. You really, you want to go through and ask some questions that people might, these aren't questions you necessarily ask when you're in Australia. Your Australian CPA might not ask you these questions because they don't really need to know. Well, it's a super and you're in Australia.
Yeah.
So these are things that you might not have asked or might not know. So sometimes we're doing a little legwork. And the sum of Mr. Castro's argument goes something like this. It's something that Australian superannuations are just like Social Security. And because they are, the treaty exempts Social Security, foreign Social Security from taxation. And that is true, foreign Social Security, the treaty does, it absolutely does. And it's true that superannuation funds are like Social Security in at least two ways I can think of. They're mandated by the government, and it's for retirement.
Right.
But when you look at what a superannuation is compared to an actual Social Security, you see some huge differences. I mean,
there are. And some very important differences. I think from a perspective of the employee, the person, the citizen, I think from that perspective, there's not a whole lot of difference. I have money that's being taken out of my paycheck, My employer's matching it. It's going somewhere else. I can't touch that money for the time being. At least not touch it, meaning I can't take it and spend it on a new pair of sneakers for myself. That looks the same to me from the Australian perspective and from the U.S. perspective. The difference is, though, what happens with the money after it exits my paycheck. And that's where all the difference is. The devil's in the details on this here. And he goes through the article and he lists several things out, which he has a point on. You know, this is mandated. Usually your IRAs aren't mandated. No one's making me open up, you know, a retirement account. The OECD has recognized the superannuations as being a part of Australia's...
He mentions it's listed in the IRS publication
Right.
about foreign Social Security.
Exactly. So he's got a point in that superannuation funds are about retirement, and when different tax authorities talk to each other about their retirement schemes, Australia talks about their superannuation funds. The United States talks about their Social Security fund. That's kind of what the government has done to mandated to have people have their citizens do to save for retirement. The problem is, though, in that the article, and he writes this in the article, the problem is that after the money leaves my account, leaves my paycheck, it goes into an account with my name on it, and it has an account number. Social Security goes into a pooled investment. That's what a true Social Security is under U.S. law. Some type of pool of assets that I pay into and then my grandfather or my father is taking out of.
Yep.
There's no account in my name. I know I'll get, and I've gotten them, a little thing from Social Security that says, here's what you'll be getting. But all that really is saying is, here are the credits that you have towards you. And for simplification purposes, we put a dollar sign in front of it. So you can kind of, you know, conceptualize it in your head. But that's not the same thing as the Australian system, which has an account with your name on it, with an account number. Your money goes into it. No one else's money goes into it. And it's not necessarily true that you don't have access to it, because under the Australian system, it's not just you have to put stuff into an IRA. It's a heavily regulated industry in Australia, and there's only, I think, a finite number of providers that you can be allowed to put your super funds into. It's not, you can't just go to the local, you know, charter a bank on the corner and say, I want them to run it. No. They have to meet strict Australian government guidelines as to what they're doing. So that's the difference, and that's what makes it not like Social Security.
There's a few other things you can think of. I mean, you do have control over the investment. You can move it.
You can move it between the different providers.
And you could even move it out and make it a self-managed.
Right, which is the connection for SMSF advisor. That's how we're talking about this.
But I mean, so Social Security, you can't do that, right?
Correct.
We don't get to choose how we are.
Invest.
Right, we don't get to do that. The other, this is, I think, one of the important distinction is that the payment, when you're paid for your retirement, it comes from the fund.
Right.
It doesn't come from the government, and that is actually a very important distinction.
Right.
Because there's something in the treaty about that, about what Social Security payments are. The treaty defines Social Security payments as a payment from the government.
Right.
So, I mean, we really have to jump through some serious hoops to say that a payment from your own superannuation fund is a payment from the government. So we're sort of at a crossroads there that doesn't quite make it. And I would say this, here's another thing. There's actually Social Security in Australia.
There is some type of old age pension that is means tested and paid out of general funds. That's what it seems to be. And you're right, when you look at the treaty and in the article they make the point that there's a savings clause, but don't worry, this part of the treaty is clawed back out of that savings clause. Savings clause being the part that basically says if you're a U.S. person, you pretty much ignore this treaty, except these few extra provisions that will allow it to remain in effect. He's right. The treaty does claw back out that part of the, or the savings clause does pull back that part of the treaty that says that payments out of Social Security or other public pensions, payments made by the contracting state, those will be only taxable in the basically the paying country. So if you're receiving an Australian Social Security, that's only taxable by Australia. Same thing, if you're getting U.S. Social Security, it's only taxed by the United States. That's absolutely correct. However, like you mentioned, Anthony, there are other things that this part of the treaty can actually attach to, and that's the old age pension amount, which is means tested and paid out of the government funds and paid by the government. Your super fund is not going to have the Australian government's name on the check. It's going to have Australia Bank or whatever it is on that check.
I would say his analysis is correct as long as he was talking about Australian Social Security.
Yeah.
It's like, yes, if it was Australian Social Security, that's there, then this is how you can treat it. But he's going, it's a really huge leap. I mean, I think that the truth about Australian superannuations is there is a lot of confusion about it. We have it, broken down. The first primary thing you want to ask is an employer or grantor. Okay, that is the most important thing. And sometimes we have our own internal disputes, or we'll want to run it by the client to go, hey, look, you're sort of in this gray area. Which way do you want to go? Here's the risk. Here's a risk this way. Here's a risk this way. And sometimes we're in a position where we can go either way, and it depends on what the client wants to do. But this, trying to claim that you could take a grantor trust where he admits, or he claims all things are grantor trust, which isn't true, but that you could take a grantor trust in Australia and say, oh, no, I don't have to pay taxes on it. There's really no basis for it. And I know you pulled up, Dennis Brager was kind enough to get a FOIA request on the Australian superannuations. We mentioned this before. He's kind enough to share it with everybody, too. And you go through that, and you could see that there's areas of confusion. There's no area of confusion on the grantor trust and what has to happen there. And did you see anything in the FOIA request that would support Mr. Castro's claim?
The one thing that I think that would maybe give some credence to Castro's position is that in this FOIA request, in these emails that were released, the people who were talking these emails do acknowledge that the IRS counsel's position on superannuation funds is inconsistent and, quote, like has holes in it. So there is some ambiguity. However, the overall point of those emails and the content of those emails did come down in the end and say, generally, this is what we do. Foreign superannuation funds, if they are employee contribution, 402B, their employees' trust, we don't tax them, we don't tax the growth, and we only tax on distribution. If they don't have that, then it's a grantor trust. And unless there's a specific provision in the tax treaty that exempts something, then it's taxable, and then you deal with the rules of 402B. And if you don't have those, there's nothing in the treaty, then you're stuck. And so the IRS's position kind of tracks what we've been thinking, and that's our reading of it. It does not track the analysis of this article.
Yeah, I mean, there's nobody in the IRS through those emails who say, oh yes, superannuation is just like Social Security.
Right.
No. And Mr. Castro makes that claim, and I would just say that I am not sure how many times, if there's actually an IRS employee who ever ratified his decision on that. If he is doing streamlined submissions, they're just accepted. If the math adds up, they're basically accepted. And we've gone through actual audits on supers, and so we know what the IRS's position is, an actual human being, and getting pushback when we bring an argument and we see what they come back with. Trust me, they really are convinced they're grantor trust. They really are. And if there was an argument, we made every possible argument with them in person to try to remove that, but you just can't. It's a grantor trust. And
we've had more people reaching out to us, correct me if I'm wrong, saying that their streamlined submissions are now being audited.
Yes.
Which is sort of a new thing in the past few months.
It's picking up, and I think, this is sort of the, when you're going to do a streamlined submission, this is my general advice, and Robert, tell me if you agree, it's like you do it right or don't do it at all.
Do it right. That's my advice, is do it.
Do it
right. And do it right.
Right, okay. Yeah, that's probably better advice. When you do, and a lot of people are kind of like, well, we don't like this tax treatment, so we're going to invent our own law because it's unfair. Look, I understand the law is unfair a lot of ways, and it just is. But when you do something that isn't quite right, well, you've done two things. You've alerted to the IRS that you're there, and you've given them a roadmap to audit you because you did the wrong thing. Compare that with somebody who's done nothing. I haven't filed anything at all. Oh. Now the IRS comes to you to say, hey, you haven't filed anything at all. Oh, I had to do that?
Didn't know.
I didn't
was
know.
supposed to.
Yeah, I was trying to figure out how to do it. I couldn't figure it out. Can you guys help me out? Okay. Because what other happens too, and this is where, and I'm not saying this about Mr. Castro. I'm just saying that, unfortunately, other tax practitioners, there's a habit of this. People will go to get help from somebody. The person doesn't do a great job, and they actually mess the case up. The IRS goes, "What'd you do with this?" Sometimes tax professionals will invent testimony to put the blame on the client. Oh, they came and they wanted to do this tax evasion.
Oh.
I mean, I don't know. It really wouldn't apply. And yeah, you right here, Robert.
Me?
And that actually happened. There's a really sad case out of San Diego from years ago. Tax attorney. He invented testimony against a couple defendants, and somebody got a little bit of time on it. And it was clear that it was invented testimony, and it's just really unfortunate. And that's why I say, be careful. You know, when someone's telling you what they want, and when someone's argument doesn't add up, you know, that you're the taxpayer, you're signing that return. This is what you don't. You can't delegate that duty to me or to Robert.
Right.
You are ultimately responsible. So no matter what, so if someone's telling you the answer you want to hear, that's not really it. When you heard the right answer from somebody else, but you're like, I'll go to this guy. He's going to do what I want to do. Well, he's doing that for everybody else, right? So the IRS finds him, and now he's like, okay, who else did you file for? Oh, good. Now we have a roadmap to everybody else. So you've been sleeping with all their clients too, in a way. And that's why it's just so risky when you see these people doing things like this. And that's why you're taking a stance that isn't supported by anything. If you were going to do this, if you're going to take, would you file up? If you believed, let's just say that you're Mr. Castro and you believe you're 100% correct, the client, wouldn't you request a private letter ruling on this? Do you think you could?
If you could, I probably would like to get one.
Right.
Definitely. I mean, because after this FOIA request that Brager released a year or so ago, the IRS isn't 100% on this either.
Right.
Make them take a position, even if it's only a private letter ruling, that they can at least say, this is not hallowed precedent. You can't rely upon this. But
you can rely on it.
you can at least go like, well, look, if we take this position, we know they're not going to just immediately throw us out the door.
Right.
Right.
They're not going to come in and, because, if you're wrong on this, this is the thing. If you're wrong on this, you have a 3520A missing. You have 3520 missing. We know that our statute of limitations, we can go back to at least 2010, or can we go back earlier?
From my reading, it seemed to be that if a statute was open when they passed the Hire Act and then and then made the law that said that
It never expires.
that these never expire, it seemed to be ones that were already open. So you might even be able to go back to 2009 or 8 or something like
2008.
that.
So I mean, you're looking at $200,000 of penalties, and we just did see the IRS did hit a Canadian with $120,000 in 5471 penalties, which are alike a 3520, and it's a foreign reporting form, so that they are really aggressive about this. And the thing is you did sort of the thing they didn't want you to do, and now you need to show reasonable cause that you relied on a competent tax professional.
I think that's maybe one of the most important takeaways of this. I wish this argument was correct, because this really is the point of the Social Security system, or the equivalent thereof, of Australia. This is the main thing that everyone does. The idea, I think, is to have, by the time you're done working in Australia, your working career, you're supposed to have like $1 million set aside. 65, great, you did it. $1 million bucks. You don't need that old age means-tested pension, public pension from us, because you're good to go. That's the whole point. So I really wish there was something. I wish there was something in the treaty. I'm really surprised that when the competent authorities between the United States and Australia were negotiating this treaty, that they put something in like this. You can't have a system where you have a whole scheme set up for people to put money away in their name
To defer income.
For retirement, because you understand that's an important social thing you want. To then just completely just like gloss over it, and then just let the U.S. I don't know if they ran roughshod over the person, or no one realized it the entire time. That's probably the main thing. Probably no one realized it the entire time. And then when you get out of it, you look at it, and everything else says, no, we did exactly. We meant everything we said in there. And then when you get to it and you compare, and you're like, oh my goodness, this is a problem now. I've got maybe a couple million people who have these things, and how many of them are U.S. persons who are actually living here in Australia, or how many Aussies have moved from the United States to moved from Australia to the United States? You know, who knows how many? And even if it's a small amount, the penalties that you're going to get hit with this stuff are going to hit you hard and going to dig into that set of funds that you set aside for your retirement when you're older, then when you're not supposed to be working, when you're on a fixed income, and you're going to be relying on this money. You know, taking out $200,000, you know, from an account when you're 40 is one thing, but when you're 65 and you're like, I need this money to live on, I can't get rid of that. You know, that's it. Like, you know, I make you know, folk art on the side and I sell it, you know, and that's all I do for right now for a little extra hobby income. I'm relying on this, and I can't get the Australian old age pension because they're going to tell me I have $800,000 left over.
And I think it bothers me just as much as, you know, FATCA does, in that these are just regular people working. They're not drug dealers. They're not trying to not pay their fair share.
They've been paying their
taxes
taxes in
Like, it has
Australia. They've been in
nothing to do with
100,
taxes.
you know, and there's Australians in the U.S. who are, you know, dealing with the same issue, and they're a little bit more sensitive to the collection power of the IRS. So there's a lot, you know, something, Mr. Castro says 100,000, and I have no reason to doubt that number of U.S. Australian citizens, and they probably all force, you know, if they're working, I mean, that's a decent amount of people this is affecting.
And just to piggyback, I would say that in addition to the kind of the outrage that I think is right, these are people who had to do this. If you're in Australia, you've got to make this. You've got to create what is, for U.S. tax purposes, one of the most punitive Rube Goldberg machine of compliance out there. And there's nothing to address this for these people. And no one in the U.S. government has a fire lit under them to get this fixed. And as far as I understand, there's not a whole lot of on the other side to get this fixed either, because it's a relatively small population and no one seems to care about them except for us, because this is grossly unfair for these people.
And I will say Karen Alper and her group is also doing a lot of work.
Yeah,
to
we
try to
had
get
her
the
on.
tax-
We had her
tax
on
treaty
before
changed. Yeah.
talking about.
We'll have to link to that video.
Yeah, fixthetreaty.org, I think.
Yep.
Yeah, it's a pretty bad treaty. I think the takeaways from this is that if you do have an Australian superannuation, don't immediately assume you have the worst case scenario. You really might not. It could be an employee trust.
It could be a lot worse, and it could be
a lot worse, right?
It could be a small problem. It could be a huge problem, but you got to find out.
I think you really want to take a look at what's going on and, you know, ask the questions, because the last thing you want to do is make yourself a target by making a faulty disclosure. You want to do it correct so that if it is something that you are selected for audit, everything is well supported, and they really don't have a good basis to come up with some penalties. Whereas if you do something sort of out there, you're kind of alone and isolated, and you might not be getting the help from your tax professional that they said they would when something bad happens. You really don't have something to rely on and fall back. And then the IRS can ultimately say, well, you signed the returns. You're a smart guy. You signed the returns. Therefore, and this is, I think, a critical thing to understand, is the IRS does not look at you as a regular person at all. They just look at it as someone to target. You have the money. Here's a $200,000 penalty, and they're fine. And they sleep fine at night. They have no problem at all. It's you need to learn your tax compliance. That's what it is. And that's what they're trying to get you to understand. So I think we've taken some tough cases and figured it out. And sometimes, you know, I mean, when you have a lot of investments and you haven't done the accounting for years, it adds up. And that's why we like it when we don't have to do the Grantor Trust.
Right.
But sometimes we don't have we are creating a larger risk if we don't do it correctly. That's why.
Yeah, I mean, I don't want these to be grantor trusts. That's an onerous system. But when you're doing it, like I said, if you're going to do it, you got to do it right. Because if you do it wrong and you're doing a streamlined submission, you're not in an audit just yet.
Yeah.
So if you're doing a streamlined submission, you want to do it right. If something pops up and they can look at this and they can say, we want to audit this set of returns because now we know this person's got foreign stuff, and we think we can get some additional penalties out of this person. If they open that up and they find out that you did that wrong, then you're in some serious heat. Then you're in some serious trouble, because now you got penalties that you have to pay that you don't have to pay under the streamlined. So what you want to do is make sure if you're going to do it, you do it right so they leave you alone.
Well, I'd just be concerned that somebody who's going to take a sort of a treatment out here might miss some other things too. Could you think of other things that pop up in a 3520, you know, with a grantor trust? What about the underlying investments? Do we get PFIC treatment on that?
The underlying investment. So all the
So that stands for Passive Foreign Investment Company,
Right.
and it's really some of the worst tax treatment
Yep.
imaginable that we always try to look to avoid, just like Grantor Trust. We're always looking to say, oh, do we have to treat this like a PFIC?
Right.
In some cases, we're like, there's really no way around it, because then there's an additional form with the PFIC.
Yeah. Yeah.
So we have an 8621.
There you go.
So if someone, so wait a second, so you're actually setting, if you're doing this vastly incorrect, you're setting someone up for at least 3 penalties.
Possibly.
3520A is missing, 3520, and an 8621,
Right.
10,000 each
Yep.
Per year.
per
Per
year.
year.
And now I don't know if we're missing anything else. There probably could be.
You don't need much else.
Yeah.
You don't need much else.
And well, that's not, and that's assuming that it's on the 8938, or the 8938 references the 3520, 3520A, and it's also on the FBAR. Because we didn't talk about those penalties, because the 8938 penalty is $10,000 per, and then the FBAR can be up to 50%.
50%.
There's mitigation guidelines, but it can be up to 50% of
Yep.
the value.
Of the value.
So that's where I'd be really leery, that if you're going to do this, you're going to do it right. And if you did do one, I would say, and you're not so sure, it's right. You can amend a disclosure.
I was gonna ask,
I mean,
so-
that's one of the IRS put that in there.
Yeah.
I mean, that was one of the first things they put in
Yep.
into the streamlined frequently asked questions, because they knew. They
So-
knew that there'd be a lot of nonsense things people would later figure out, wait a second, I think it did it wrong.
Well, also
you can
because-
come back and fix it, and still no penalty as long as you're living in Australia.
And I'm sure, I mean, like that FOIA request, the IRS isn't clear on some of this stuff either. So, a bit of mercy from them on this. They allowed you to have a little bit. Okay, look, if you made a mistake, you can fix it. Go ahead, because we don't know what we're doing either.
It's true. So we can help with people that have questions about their superannuation funds. And correct me if I'm wrong, we have the streamlined submission review.
Yep.
So
Yes.
even if you have submitted it, we can still review it.
Oh yeah.
Oh.
If you've done it and you want to take a look at it before it goes
You
out,
know, get another set of eyes. Just
What if
say,
it's
hey,
already gone out?
we could do it still.
Yeah.
Because we always can amend it.
yeah, we can always amend it.
Yep. And even if you're under audit, we can help you out too. We help out there. There's just a lot of, unfortunately, that there's far too much brain power. Some of the best brain power in the world is attacking the U.S. tax system because it's so complicated. Unfortunately, there is a shortage of that brain power. Unfortunately, it's just not for everybody. It is incredibly difficult. It was incredibly difficult to find a talent like Robert. They don't make many of him.
For good reason.
And so
for victory.
that's really the unfortunate truth about it, is that there's a lot of people who do things incorrectly, and we catch a lot of errors, and it really doesn't matter who it is, by attorneys, by CPAs, by anybody. It's taxes, it's international. Mistakes are bound to happen.
Not everyone geeks out about it like we do.
I guess
You
not.
should see our passionate lunchtime discussions about international taxes. All right.
Heated discussions.
Heated. Attorney Hanson, thank you so much for joining us today.
Thank you for
If you
having
do
me.
have any questions about your superannuation, don't hesitate to contact us. It's 888-727-8796. You can also email info@irsmedic.com. Any information you share will be kept confidential. You can like and comment below and subscribe to our channel for more awesome tax updates. Thanks so much for watching.